Silver just broke $80 today. As I'm recording this, silver is trading above 81, and I need to explain to you why this move is different from every other move we've seen this year. Because what's happening behind the scenes right now is the biggest short squeeze in the silver market that nobody is talking about. And it involves one of the largest banks on the planet, a country that got addicted to cheap silver and got caught short. And a physical demand surge so extreme that one of the biggest bullion dealers in the world just reported numbers that made me stop and reread them 3 times. Silver went from $30 to $120 in less than a year. Then it crashed 47%, and now it's climbing back. Just reclaimed 80. The next level to break is 85 to 86. If that breaks, 100 is on the table. And I'm going to show you exactly why the setup for that move is stronger right now than it was before the crash. But first, I need to take you inside what actually happened over the last 6 months. Because the story you think you know is not the full story. Not even close. And by the end of this video, you're going to understand why silver at $80 could be a launch pad, not a ceiling, and why the next move could take it much higher than most people expect. Let's start with the physical demand, because the numbers coming out right now are staggering. One of the largest physical bullion dealers in the world, based out of Singapore, just reported their January numbers. And I want you to sit with this for a second. In January alone, they did over 350 million Singapore dollars in physical gold and silver sales in 1 month. They sold over 65 tons of physical silver in just December and January combined. 65 tons. That's over 2 million ounces in 2 months from a single dealer. But the part that really caught my attention was the split. In January of last year, gold was 75% of their revenue and silver was 25%. This January, it was 50-50. Silver went from a quarter of sales to half. And this happened while silver was at all-time high prices, not on a dip, not on a correction. At the highs, their customers were increasing allocation to silver at elevated prices, not reducing it. I need to say that again because I think people need to hear this. Physical silver buyers tripled their buying year over year at record high prices. That tells you something about the conviction in this market. This is not speculation, this is accumulation. And it's happening at a pace that is breaking the supply chain. The same dealer had to implement a $5,000 minimum order. They had 8-hour queues at their physical location, hundreds of people waiting in line every day. Their management was on the floor, serving customers personally. Mints stopped accepting new orders. Refineries are backed up until April. Some aren't even taking calls. And this is one dealer in one country. Multiply this across the globe and you start to understand the scale of what's happening in physical silver right now. Now, why does this matter for the price? Because when physical demand outpaces supply at the dealer level, at the refinery level, at the mint level, the paper price and the physical price start to diverge. And that divergence is exactly what's been happening. Shanghai has been paying massive premiums over the Western spot price. Miners have been selling silver 15 to 26% above COMEX. The real price of silver is not what you see on your screen. The real price is what buyers are actually paying to get metal in hand, and that number is well above $80. Welcome to the hidden economy. If you're new to the channel, subscribe. I'm covering the silver market every single day right now. The COMEX data, the delivery reports, the miner earnings, the physical market, all of it. So please hype this video for the algorithm. And trust me, you don't want to miss what I'm about to show you next. Now, I want to take you inside the story that connects all of this because there's a reason physical silver is this tight. And it starts with something that happened over Thanksgiving. I've been digging into the COMEX warehouse data and the delivery reports for months. And what I found is a pattern that I think explains everything. In late November around Thanksgiving, one of the largest bullion banks pulled 13 million ounces of silver off the COMEX. 13 million ounces in one move. They took registered silver, which is silver available for delivery, and converted it to eligible, which means it's still in the vault but no longer available for anyone to claim. They essentially said, this silver is mine and nobody else can have it. But it gets more interesting. The same day this happened, the CME, the exchange that runs COMEX, experienced what they called a cooling issue. Their systems went down right at the moment this massive silver move was being processed. Now, I'm not going to speculate on whether those two events are connected. I'll let you draw your own conclusions, but the timing is remarkable. So why did this bank pull 13 million ounces off the COMEX? I've spent weeks piecing this together from delivery data, warehouse reports, and refinery information, and this is what I believe happened. A major Chinese industrial entity was short silver. They had obligations on their own exchange, and they tried to hedge that short position on the COMEX by taking delivery of physical silver. And the bank that controls the largest share of COMEX silver said, no, you can't have it. Think about what that means. A Chinese industrial, one of the biggest consumers of silver on the planet, tried to take delivery of silver that was supposed to be available, and the bank that held it refused. Instead, they offered to source the silver separately on their own terms, at their own timeline. They told the Chinese side to roll their contracts forward and wait. And while the Chinese were waiting, the same bank was going into Latin America and buying up silver concentrate, the same concentrate that had been flowing to Chinese refineries for years. They were pulling supply away from China and bringing it into the U.S. This is where the short squeeze begins. China has been the largest consumer of physical silver for years. They've been buying every dip. For 5 years straight, Chinese buyers, both industrial and investment, got addicted to cheap silver below $30. They built their entire supply chain around it. Their refineries, their electronics manufacturers, their solar panel producers. Everyone assumed silver would always be available and always be cheap. And then the price started moving. 30 became 40, 40 became 50. The producers started hedging. The retail sellers in the West started dumping their old coins. Refineries got backed up. And somewhere in the middle of all this, the banks that had been keeping silver cheap for decades flipped. They went from short to long. And China got caught on the wrong side. What happened next was panic. When the bank pulled silver from COMEX and cut off Chinese access, Chinese industrialists started going directly to mines in Latin America. And they weren't offering spot price. They were offering $80 an ounce when spot was $70. Think about that. Chinese buyers were paying a $10 premium per ounce just to secure physical supply. That tells you how desperate the situation had become. And we have proof of this now. When the major silver miners released their Q4 earnings, the numbers confirmed everything. One of the largest primary silver miners reported an average realized price of $69 and 74 cents per ounce when the average COMEX price during the same period was $55.20. That's a 26% premium. Another major miner reported similar numbers, $15 per ounce above the COMEX average. Someone was paying these miners far more than the official price. And based on what I've been tracking, I believe a large portion of that premium buying was coming from entities that had been cut off from their normal supply channels. The premiums tell the story that the spot price doesn't. Now, I want to connect this to what happened in China's own market, because the squeeze didn't just happen on COMEX, it happened in Shanghai too. China has only one major vehicle for non-futures silver investment. It's a fund, essentially their version of a silver ETF. And during the rally from 70 to 120, this fund started trading at a 30% premium above its net asset value. 30%. The fund manager was literally issuing public statements begging people to stop buying every day. Stop buying. The fund is trading above its value. And people kept buying. Inside China's silver market, there was a civil war happening. On one side, you had investors who were piling into silver, driving the fund higher, creating demand that the market couldn't absorb. On the other side, you had industrialists who were short silver, who needed the price to come back down so they could cover their obligations. These two factions were pulling the market in opposite directions, and then it broke. On January 30th, the fund was shut down. Not when silver was falling, but when silver was rising. They went liquidation only. If you've studied silver market history, you know what that means. It's the same thing that happened to the Hunt brothers. You can buy all you want on the way up, but when it gets too dangerous for the system, they change the rules and you can only sell. Shanghai went limit down 17%. Their market has a circuit breaker. The US market doesn't. Silver dropped over 40% in the West. The paper price crashed, and everyone watching from the outside thought the silver bull market was over. But the reality was different. The crash was engineered to relieve the short squeeze in China. The industrialists who were short got their bailout. The fund was destroyed. The speculative excess was purged. And the price dropped from 120 to 64 at the low. And then something remarkable happened. Silver didn't die. It stabilized. It found a floor at 70, and it started climbing again. 72, 75, 78, and now today, 81. But before I explain why I think the $70 level could hold as a floor, I need to take you back a few months further. Because there's another piece of this story that most people missed entirely, and it's about what happened in London, the London bullion market. The LBMA is supposed to be the deepest pool of physical silver in the world. Banks trade silver with each other through what's called an interdealer market. It's like borrowing a cup of sugar from your neighbor. I lend you some silver today, you give it back tomorrow. The cost is basically zero. That's how it's worked for decades. Very friendly, very casual, very buddy-buddy. And the whole system ran on one assumption, that there would always be enough silver to go around. In October of last year, that assumption broke. The interdealer lending market in London seized up. Banks stopped lending silver to each other. And when they stopped lending internally, they had to go to the public market to borrow. And that's when lease rates exploded. Silver lease rates going from near zero to levels that screamed crisis. That was the first signal that something fundamental had changed. The LBMA didn't have the silver it claimed to have. This is where it gets wild. Based on what I've been able to piece together from the data, I believe what happened is that China loaned the LBMA roughly 30 million ounces in October to cover the shortfall. The LBMA used that silver to fulfill obligations to India. Chinese silver shipped through London, ending up in India. The LBMA bought itself 90 days, a 3-month lease, and you can see it in the Shanghai data. Shanghai warehouse inventories dropped consistently through November and into December. Then suddenly, for about 2 to 3 weeks, they went up. That was the silver coming back from London, the LBMA returning what it borrowed. But it wasn't enough. They couldn't return it all. And after those few weeks, Shanghai inventories plummeted again, faster than before. China lent its silver to bail out London. London used it to supply India. And when the loan came due, London couldn't pay it all back. China went from being the lender to being short. That's when the panic I described earlier kicked in. That's when the Thanksgiving COMEX pull happened. This is an incredibly complex story, and piecing it together has taken a tremendous amount of research. If you appreciate this kind of deep dive analysis, make sure to like this video and subscribe to the channel. We're just scratching the surface of what's happening in these markets. Thanks for watching. That's when the desperate buying at premium started. The dominoes fell one after another. I want you to understand the chain of events here because it reveals how fragile the entire silver market is. London runs out, China bails them out, China runs short, China tries to take delivery from COMEX, the bank says no, China panics, the fund blows up, the price crashes. And through all of it, the actual physical silver available on planet Earth did not increase by a single ounce. Everything that happened was about who owns the silver that exists, not about whether there's enough, because there isn't. This is the part that tells me the bull market is not over. In 2011, when silver crashed from 50 to 20, it didn't come back for over a decade. In 1980, when the Hunt brothers were broken, silver collapsed and stayed down. This time, the crash happened, and within 3 weeks, silver was back above 70 and pushing toward 80. The recovery speed tells you the structural demand is real. The crash was artificial. The demand is organic. And here's why this time is different. I don't say that lightly. Those are the most dangerous words in finance. But let me give you the specific reasons. In 2011, there was no supply deficit. Silver was abundant. In 2026, we've been in deficit for 5 consecutive years. Above-ground stocks are depleted. The LBMA is out. COMEX is draining. Shanghai is empty. In 2011, silver was not on any country's critical minerals list. In 2026, the US government has designated it a critical mineral. That changes everything about how the government and its banking proxies treat silver supply. In 2011, there was no 2-tier pricing. COMEX said $30 and that was the price. In 2026, COMEX says 80 and miners are getting 69 to 70. Shanghai is paying 99. The paper price and the physical price have diverged in a way that has never happened before at this scale. In 2011, the speculative blow-off top was obvious. Miners were going parabolic. Retail was euphoric. Everyone was buying. In 2026, the silver to miner ratio is bottoming. Retail was selling at 50. Producers were hedging at 50. The speculative blow-off hasn't happened yet. What we saw at 120 was just a preview. The real top is still ahead of us. In 2011, no major power was hoarding silver. In 2026, the largest bank in the world is pulling silver off exchanges and redirecting supply chains. That's not speculation. That's in the COMEX warehouse data for anyone to read. So when someone tells you the silver bull market is over because it crashed 47%, ask them to explain all 5 of those differences. I'll wait. And now let me tell you why I think 70 could be the floor for this cycle. I could be wrong. Silver can always surprise to the downside, but the data is building a strong case. There's a major streaming company that just cut a $3.6 billion deal with one of the world's largest copper producers to buy their silver byproduct. And the deal effectively pegs silver at around $7 to $75. That's a multi-billion-dollar bet by one of the smartest money players in the mining space that silver stays above 70. They could be wrong, but that's a lot of money to put behind a conviction. Add to that the miner earnings data. When 2 separate primary silver miners are getting $69 to $70 per ounce consistently quarter after quarter, that's not a spike. That's a new baseline. That's where the real market is pricing silver regardless of what the paper market says. And here's what I believe is the biggest factor that nobody's discussing. I think the US government, through its primary bank proxy, is actively hoarding silver. I think the silver being pulled off COMEX, the concentrate being redirected from Latin America, the delivery refusals to Chinese entities, all of it is part of a deliberate strategy to secure silver supply for the US market. Silver was added to the US critical minerals list last year. That wasn't symbolic, that was policy. And when you combine critical mineral designation with the fact that the dominant player in COMEX silver is aggressively pulling supply off the exchange and redirecting it from traditional Chinese buyers to US entities, the picture becomes clear. This is a resource war. Silver is a strategic asset, and the US is making sure it has enough of it. This is a proxy war between the largest economies on Earth being fought through commodity markets. On one side, you have the U.S. banking system actively cornering physical silver supply, redirecting concentrate from Latin America, denying Chinese delivery requests, and building strategic reserves. On the other, you have China desperately trying to source silver from anywhere it can, paying massive premiums to miners, running joint military exercises to protect shipping lanes, and watching its internal silver market implode from the structural contradictions of its own fund system. And it's not just silver. Look at what's happening in oil. The U.S. moved into Venezuela and secured access to cheap oil for itself, while simultaneously cutting off supply to China. The message is clear. If you want to hold rare earths from us, we'll make oil more expensive for you. If you want to restrict mineral exports to the West, we'll redirect your commodity supply chains. Silver was the leading edge of this. Silver bled first. Oil is next. Think about what that means for the price of silver. This isn't just a supply and demand story. This is a geopolitical chess match where silver is a strategic piece. The U.S. doesn't add metals to the critical minerals list for fun. They don't let Wall Street's biggest silver vault hoard tens of millions of ounces for no reason. They're preparing for a world where commodity access determines economic power. We're entering what I'd call a mercantile era, an era where you have to own the natural resources and control the refineries and sell the finished goods. And right now, the U.S. doesn't have enough refineries. That's why they're building them, and that's why they're stockpiling the raw material. Silver is not just a precious metal anymore. It's not just an industrial metal. It's a weapon in a global resource war. And weapons don't get cheaper during a war. They get more expensive, much more expensive. Now, the technical picture, silver just broke above $80. This was a major resistance level. The last time silver was at 80, it was on the way down from 120, breaking back above 80 with momentum, with physical demand surging. With the short squeeze still unresolved, that's a technical signal that the correction is over and the next leg up has begun. The next resistance is 85 to 86. I'm watching this level very closely. If silver can break through 85 and hold above it for a few sessions, the path to 100 opens up quickly. There's very little resistance between 86 and 100 because the move from 80 to 120 happened so fast that there aren't many established trading levels in that range. It was a straight shot up and a straight shot down. So once 85 breaks, we could see silver accelerate. And here's why I think it will. The conditions that drove silver from 30 to 120 haven't changed. They've gotten stronger. COMEX registered silvers at the lowest level of this cycle. The vault is still draining. Physical demand is still surging. Bullion Star just posted record numbers. Refineries are still backed up. Mints are still not taking orders. The silver deficit that's been growing for 5 years hasn't reversed. It's gotten worse. The only thing that changed was the speculative fringe got wiped out in the January crash. The fund in China got destroyed. The leveraged longs got margin called. The weak hands sold, and what's left is structural demand from industrial buyers, strategic demand from governments, and conviction buying from physical investors, who tripled their allocation at record prices. That's the strongest possible base for a new rally. Speculative excess purged, fundamentals intact, physical demand accelerating, and the short squeeze between the world's two largest economies still unresolved. Let me tell you what I'm watching for confirmation. 4 things. First, silver needs to hold above 80. Today's break is significant, but it needs to be sustained. If silver closes above 80 for 3 to 5 consecutive sessions, that's confirmation that 80 is the new floor, not just a touch. Second, I'm watching COMEX delivery data. We're heading into the March delivery cycle. If deliveries come in hot, if the drainage rate accelerates, if more silver gets pulled from registered to eligible, that tells me the hoarding is continuing and the squeeze is intensifying. Third, watch the miner earnings. More companies will be reporting Q4 and early 2026 numbers soon. If we see consistent premiums of 15 to 25% above COMEX and realized prices, that confirms the two-tier market I've been describing. The paper price says 80. The real price says 95 to 100. Fourth, watch the physical dealer premiums. When dealers are charging 8, 10, 12% above spot and still running out of product, that's the market telling you the spot price is wrong. The spot price is a fiction maintained by paper trading. The physical price is reality, and reality always wins eventually. Now, let me talk directly to you because I know people are in different situations right now. If you held through the crash, congratulations. That took conviction. You watched silver go from 120 to 64 and you didn't sell. That's not easy. And the fact that silver is now back above 80 vindicates that decision. Nothing I've shown you today suggests the structural story has changed. You're holding an asset that is being hoarded by this bank for strategic purposes. Don't let a correction shake you out of a position that governments are trying to build. If you sold during the crash, I'm not going to judge you. Watching your position get cut in half is terrifying. But understand what happened. The crash was a structural event caused by a Chinese fund implosion and coordinated selling to relieve a short squeeze. It was not a change in fundamentals. The deficit didn't reverse. The vaults didn't refill. The critical mineral designation didn't get revoked. Everything that made silver go from 30 to 120 is still in place. The question now is whether you get back in at 80 or wait until it's back at 100 and feel like you missed it again. If you're new to this market, I'll give you the simplest framework I can. Silver went 4x in less than a year. It corrected nearly half. It has now recovered above 80. This is what bull markets look like. They don't go straight up. They rally, correct, consolidate, and then rally again. The correction already happened. The consolidation is happening right now. The question is whether the next rally takes silver back to 120 or higher. And based on everything I've shown you today, I think the odds favor it, but I'm not married to a number. I'm watching the data. Here's my personal take on where we are. I've been following these markets closely, and I've never seen a setup like this. You have the world's largest bank hoarding physical silver. You have China short squeezed and desperately trying to source metal. You have physical sales triple year over year at record prices. You have a 3.6 billion streaming deal that pegs a floor at 70. You have miners confirming the real price is 26% above COMEX, and you have silver breaking above 80 with momentum today. The people who are bearish silver right now have to explain all of that away. Every single data point, and I don't think they can. I'm not saying silver goes to 100 tomorrow. I'm saying the setup is there. 80 is broken. 85 to 86 is the next wall. If that breaks, 100 becomes the next logical target. In my analysis, the probability is high. But silver can always surprise you. What I do know is the structural factors driving this market are not going away. They're intensifying. The resource war between the US and China is escalating. The physical deficit is growing. The vaults are emptying. And the smart money, the miners, the streamers, the sovereign buyers, they're all positioning for higher prices. The paper market crashed silver nearly in half in January. And within 3 weeks, it was back above 70. Within a month, it's back above 80. That tells you everything you need to know about the strength of the underlying demand. You can crash the paper price, you can liquidate funds, you can change margin requirements overnight, but you cannot create silver that doesn't exist. You cannot fill a vault that's been draining for 5 years. You cannot force physical buyers who are tripling their purchases at record prices to suddenly stop wanting silver. The squeeze is not over. It's just getting started. Drop a comment. Which scenario are you positioned for? 85 this month, 100 before summer? I'll pin the best from both sides. If you haven't seen yesterday's video on the Iran war situation and what it means for silver, watch it next, link in the description, and share this with someone who holds silver and doesn't know what's happening behind the scenes. They need to see this before Monday. This is The Hidden Economy. Stay sharp, stay stacking.